You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.
Thanks, Joe. I'd like to thank Ms. Lim. I'd like to welcome Yamaji-san from OSE. I'm going to have to lean down a little bit so you can hear me. I'm Bill Herder. I'm the head of the region for Asia Pacific for FIA. I'm based in Singapore. I've been in the role for about 7 years now, and I would like to thank Phillip for inviting me to this wonderful event. Today I've been asked to speak about, well, before I start, there's 2 things I'd like to state. One is that I have to do this. The views I'm going to give today are my own and not necessarily those of our members or of anybody else. The other one is that I did have a speech completely written that was really, really good. However, it is now on the table in the lounge in Doha. I left it there when I was traveling through. But the first panel was very informative and based on what I was going to say. I've been asked to speak about the growth of the industry in Asia. Usually when people talk about this, they talk about the volumes. And that is almost a lazy way out. Anyone in this room could go to the internet and check the volumes in Asia. I think the more interesting area of the growth in Asia is actually what these gentlemen were talking about. It's the infrastructure and the products and the regulations that is allowing the cross-border trades. I cover everything from Wellington, New Zealand, to Dubai, to Seoul, Korea, and everything in between. In the last 7 years, the conversations I've had have changed dramatically. People are now talking about how do they gain access? How can they involve different areas, different traders? It's not just about the trading, it's the sustainable volumes. It's the open interest, it's the hedging. Phillips Capital does a wonderful job of bringing a multitude of investors into the industry across the whole region. A shameless plug too, Phillips Capital will be our newest member of FIA by the end of the day. I'd like to thank them for joining. Besides that, I do think that the number of exchanges out there have all done a remarkable job of adding innovative products, about advancing technologies, and about setting about and working with the members and their competitors to extend the reach of Asia. The growth of Asia is not about strictly volumes. We have seen things such as the example of the KRX, which had by far the largest traded contract in the world a mere 5 years ago. Now, there's far less volume on that contract, but in the opinion of most people, the KRX has grown dramatically. And they've grown because of their maturity. They have offered things to institutional trading. They have had rule changes, simple things like error trade policy, omnibus trading, and it's educating the regulators, and working with the regulators to understand the exchange-traded derivatives market. Now, we always look at Asia and say, oh, they're new. They are. If you look at the grand scheme of things, the Chicago Board of Trade, the first contracts were traded back in the 1860s. Outside of Japan, which is the most established in the region, the oldest exchange in the region would probably be SGX, which celebrated their 35th anniversary 2 years ago. These are extremely young exchanges, and for what they've done in that time is remarkable. Technology allows the globe to look at the Asian exchanges. It allows them to see the opportunities that are out there. China has been the focus of so much of the news. China is one piece of Asia, and actually, at this point, even though they opened up last year, they really still have major barriers to opening. When that does happen, that will open up the region even greater. I think Gift City is a prime example that Matthew was talking about in the first panel. Gift City is an initiative to attract international traders, to attract a new level of investor, mainly based at the institutional trading in the Indian marketplace, which has been a hugely retail-based market. Now, there are political reasons why it's very difficult to change it onshore in India. Now, those policies and things like a joint venture, which is being worked on between the SGX and the NSE, and the things that BSE are doing. This is the growth in Asia. The growth in Asia will be seen in volumes over time. But the growth from the maturity of the market, where it's going, regulatory advances that have noticed the ability to cross-border trade. The most amazing thing is that probably, as opposed to my counterparts in Europe and the US, who spend a great deal of their time advocating for the change of regulations, we spend the majority of our time educating the regulators, educating them why exchange-traded derivatives are important to the real economies of their nations, educating them why opening up to a very diverse and global marketplace is the key to a safe and risk-mitigated marketplace. Now, Asia the volumes are growing at a sustainable rate, which is key. They are also getting new products, whether it's crypto, which they are making advances, but much to my relief, they are doing it in a very smart and they're keeping an eye on the risk and trying to keep the scammers out. Now, which is make a creditable marketplace that's critical. However, every exchange, when they were talking here, nobody really talked about volumes. They talked about the advancements they're doing in rule changes and product advances and things of that nature, which are the key to increasing the market share. They talked about the Vietnam exchange, which is starting up. They talked about Indonesia, ASEAN itself, the Association of Southeast Asian Nations, is a massive trading bloc that when they get together between Thailand, Malaysia, Singapore, Vietnam, Cambodia, Laos, Indonesia, these are all countries that have a huge amount of wealth when it's combined, and a massive amount of natural resources, and the mindset to make this work. But I believe that the growth in Asia, the opportunities in Asia, are in front of us to be taken, and with the advances that the exchanges have made in extending trading hours, what they've made in the ability to clear, what they've made in technology, makes these accessible from a global standpoint. And I do believe that Asia will grow at a sustainable rate over the next however long, and it will be continue where they are, and Phillip's Capital will be at the forefront of all this. Thank you.
All right, thanks, Bill. We agree. I'd like to welcome up the second panel. and our moderator, Phillip Capital's very own champion, and Head of Business Development, David Klatz.
Thank you. Yes. Rama. Ah.
We don't need Rama.
I knew I saw you.
We don't need Rama, Dave.
Always waiting on you, man. What do we know? Always of you. Thank you all for staying for the second panel, or as I like to call it, my yearly spar with the Chris's. This year we're really happy to have James Lear, the Director of Proprietary Trading for the DME, Chris Lee, Senior Vice President for HKEX, Chris Edmonds, Senior Vice President for ICE Singapore, and Rama Pillai, Senior Vice President and Chief Commercial Officer for SGX. James, can you take a couple of minutes and speak about your latest initiatives?
Hi, I'm James Lee. I'm a head of sales at the Dubai Mercantile Exchange. We host to the Oman Sour crude contract, which is the biggest deliverable crude contract in the world. We're 50% owned by the CME Group, so all our trading and matching is done here in the States from Globex and Clearport. And we are also, as of this summer, the exchange of choice for Saudi Aramco, who switched 50% of their pricing onto the exchange in July, their first pricing switch for 34 years. So it's exciting times for us, that's for sure.
Chris, can you tell us what's going on with HKEX, aside from the drop in price in 10 cents?
You didn't wait to get that hit in, did you?
I couldn't wait.
So look, I'm a salesman, so I'm going to move straight to the point. This slide up there shows our after-hours futures market that we extended late last year into an area where you guys, if you're a derivatives trader, could easily trade it. We've experienced about 222% growth in that market, in our index futures market, and we've now got it open so you guys can trade it till about 12 p.m. till your lunchtime, and soon we'll have it open early next year, mid next year, so you can trade it till 2 p.m. your afternoon. We've put index options into our after hours. We've experienced 150% growth in the index options once we put those in our after hours. So in all, I'm just going to try and sell you HSI futures, HHI futures, minis, based on the growth in our day volume, which has now been spurred on by our after hours volume. Aside from that, we've had a big year in the cash market, but I'll come on to that later.
Great, thank you very much. Chris?
Yeah, obviously we have ICE Futures Singapore within the region and have continued to add to those product base, and most of that is coming from the equity index derivative products that are in the region. We get the opportunity to compete with my dear friend to my left on some of the MSCI product suite that is active in there, given its impact with Chinese A shares being listed and some of those products that we have there. Obviously, Asia for us, and Singapore in particular, which is a bulk of our operation. To give you an order of magnitude, 10 years ago we had 3 people sitting in that office. Today we have 250 people in the region if we include our outpost in Australia. So continue to invest in our data products as well as new listed derivatives, both on the local exchange as well as supporting the activity across our other global exchanges based in the US or in London at this time.
That's great, thank you. And finally, Rama.
Thanks, David, and thank you for once again inviting us just to be part of this Asian Trading Symposium. We find this annual visit out here to be very important to help the marketplace keep abreast of what's going on out there in Asia. The slide I have up there is self-explanatory. I'll talk around it just to highlight a few points. Picking up from where Bill Herder, our previous speaker, made a few points. I mean, Asia is vast. Asia is huge. You're talking about almost half the world's population in that area, and huge engines for growth of not just China and India, but Southeast Asia itself. SGX, our value proposition, our reason of being essentially is to try and be an Asian gateway, essentially an entry point into Asia, to make it as easy and as comfortable for participants to participate in multi-asset access through a single marketplace. One can do so through the various exchanges on the previous panel as well as on this panel. Our value proposition is that by bringing everything in one place, makes it a bit more easy for participants to get involved. As a result of which, year on year, we keep seeing growth in our products across all asset classes, growth in client base. The slide up there indicates the first quadrant talks about the growth in our volume. As expected, like most exchanges, we do see growing flows coming onto our platform. As I mentioned, in our case, it's across all asset classes, the equity, the FX, and the commodities pieces as well. What's more pertinent perhaps for this group is the top right quadrant chart, which kind of indicates the flow of what's happening in this time zone. Where we used to in the past see no more than about 5-6% of flows coming from the United States time zone. We have now reached 14% on average across all our products, with some products going as high as 20-25%. So there's a good liquidity pool that's coming out of this time zone from participants here who want to trade during the Western hours of Europe and the United States close. The bottom two quadrants just talks about some of the newer products that we brought to market. Foreign exchange, which is a big asset class for us now. We have 21 currency pairs, all Asian currencies, and we're fairly strong in the rupee and the CNH contracts. That's on the back of the cross-margining, as Chris just mentioned kindly, that we have cross-margin capability to make it more efficient for a person to actually hold their portfolio in Singapore. And the last thing is the INR screen. INR is interesting for many reasons, one of which is that the way it's developing, it seems to be potentially a macroeconomic indicator for the growth of China, and one can track and see. So essentially, Singapore is the marketplace where iron ore produced in Australia, consumed in China, but transacted in a neutral place, i.e. Singapore. And the flows that we're getting really could be a macro indicator for the growth of the marketplace. What's interesting about that quadrant is that a good part of that business is now starting to go on screen. It's not just swap participants, but it is screen players getting involved, which is the financial participants like you all, who may want to also participate in that potential product opportunity.
Thank you. I'm going to keep you on the line here.
Sure.
This fall marks the 10-year anniversary of the financial crisis. Can you reflect on where your exchange was 10 years ago, how the focus has changed or evolved, and how the last 10 years have affected your markets?
Big question. Many different dimensions to look at. I would say, if I were to have a synopsis of the whole matter, I would say we have seen a lot more flow onto exchange platforms broadly, ours in particular, ours as well, not in particular, as more of the business is trying to find home for clearing, OTC transactions coming onto exchange platforms for clearing their businesses. And we're seeing this in all our asset classes. As there's greater need for price transparency and record transparency, participants are looking for platforms where they can actually easily move positions for clearing, and we have managed to support that and facilitate that endeavor. Another thing I would say is that we have seen, as expected to some extent, the big banks, the big FCMs have got bigger, but at the same time, given the changes in regulations and the way the market has evolved, the non-bank FCMs have actually started to play a bigger role as well, at least in our part of the world. And not because I'm here at the Phillips event, but Phillips, being one of the examples that I've seen, has actually gone from strength to strength as a non-bank FCM to facilitate a broader group of clientele. So that's another phenomenon that I've seen over the last 10 years. And yeah, I think, frankly, what we're seeing is just the tip of the iceberg. There's still a lot more flow that's going to come onto exchange platforms. Thank you.
Chris Edmonds, your exchange is somewhat new on the scene, but can you explain maybe the genesis of ICE SG since 10 years ago and what you see for the region going forward?
Sure. So obviously 10 years ago we didn't exist as ICE Futures Singapore. We looked for the opportunity to have a footprint within Asia. That came to us a little over 5 years ago. When that opportunity presented itself, and we continue to invest in that region, not only on the exchange footprint, but also within the data assets. And I bring that up because of a point that Rama made around more and more products looking to find their ways onto a listed venue or into a cleared environment. We're certainly seeing that from both the data side as well as from our trading activity within the region. And it'd be remiss to say that, you know, during Asian hours, I should say that during the trading day, about 33% of all the volume we see in our crude complex comes out of someone domiciled in the Asian time zone. So that continues to grow, and I think that's consistent with what Jamie's seeing from his vantage point as well. But this, as much as things have become consolidated and looking for a home on listed exchanges, and can't happen without the intermediation of companies just like Phillip Capital here, we also have a fragmentation going on in the activity because of the regulatory changes Rama made mention to. The impact that has on how you gain access to any of these listed environments is becoming slightly more complicated over time, and requires a bit of hand-holding exercise to make sure that you navigate that correctly. I think if I were to look and go forward, while the last 10 years have given us this opportunity to create even greater activity within the region, it's also raised some questions. And I think in some cases, as much as China represents this massive opportunity for the entire world, and Lynette made comments about that in her opening remarks, it also raises a separate set of questions about how do you adequately access that without tripping wires, either in your home regulator or within a given exchange environment that you're looking at. So all of those, I still think there's work left to be done that we're all going to have to roll up our sleeves and find a way through.
Thank you. Chris Lee, how would you?
Yeah, so just to set the scene, 2008 I think was the Beijing Olympics when you saw those massive construction projects going on in China, and they built that bird's nest of an auditorium for the Olympics. I looked at some stats. In 2007, our index future was trading around 30,000 points, and today we've been trading 33,000 points, so it's kind of a little bit dull. But in 2008, it dipped by it went down to about 10,000, so we lost about 2/3 of the value just on that in that 2008. We're a big cash equity exchange as well, so we're aiming to be #1 listing venue this year with about $30 billion raised. We've done about 26 billion so far this year. In 2008, we strangely enough did about $30 billion of capital raising, and we were #1 listing venue in the world. So I kind of trying to find what's different. But I think what's really different is China. China's now added 100 million people to its population in the last 10 years. We're in Hong Kong. We've only added about 500,000 population, but China's added 100 million people. But China's become wealthier. It's become it's done, as I said, big infrastructure projects over those last 10 years, and I think that's the opportunity that we're all looking at. And in the middle of those 10 years that we talk about, between 2008 and 2018, we actually went into the data center space. We were probably way behind most exchanges and built a co-location center for the prop algorithmic high frequency guys and everybody else, and started expanding that business out. So I think that, coupled with the products, the opportunity in China, and the growth of China that you see over the border from Hong Kong, is probably the biggest change that you'll see, rather than contract asset values or positions in the world.
Thank you. And finally, James, how has DME evolved over the last 10 years?
Yeah, we're going back 10 years. I mean, I was on the other side. I was running a large prop in Dubai for about 40 traders, and I can safely say that none of those traders looked at the exchange that was just down the road, which was interesting. And then the biggest change for us came with CME involvement from 2011, which really put the exchange back on the map and opened it up to everybody. And then what I got from when I was still in the trading side then was a lot of requests from traders about access into the DME. And then when I joined the DME 5 years ago, I knew then that we had a large customer base around the world, not just in Dubai, that could have access to this market, and there was a real demand for that. And I've seen in the last few years a kind of a small parochial exchange that was really set up for commercial customers to hedge their barrels into a truly global exchange with all types of customers across the board, many of whom are not interested in taking delivery of any oil, but quite happy to trade the contract. And that's been a big change over the last 10 years for us.
I'm not going to let you off the hook, James.
Thank you.
So you weren't on the panel last year, but I had asked how MiFID and Brexit were going to affect the Asian markets. Can you reflect on how MiFID and Brexit are impacting DME and Dubai and the space there?
Well, quite frankly, they haven't had a huge impact. The only impact I can see in Dubai in general is the growth in a culture of a trading hub. I mean, we've had a lot of people, props and customers in general coming to the region in the last couple of years, and a lot of this is, for want of a better phrase, a regulatory arbitrage. They're looking to escape certain regulation elsewhere, and they find a place to be is in Dubai at the moment. For me, that means I've got a lot of customers on my doorstep for the first time, which is nice. It means I can visit these guys on a regular basis and hopefully change things for their suiting. I mean, apart from that, there's not been a great deal of difference in the exchange and the way we do business, but it's interesting to see Dubai becoming a trading hub as opposed to sort of a backwater.
Thank you. Chris Lee, how's that impacted you?
Yeah, look, I think Asia was fairly slow in realising perhaps some opportunity in the MiFID and Brexit story. We're in a strange position because we own the London Metal Exchange in London, so we have clients that would struggle, that may have to change the way they're set up to trade into Europe, but then the Europeans to trade into the London Metal Exchange. But then those clients also possibly could trade HKX in Hong Kong. So we're seeing a little bit of clients coming around to Asia, setting up entities or using their Asian entities or planning to use their Asian entities to trade into those markets without having to perhaps do some of the rigmarole or have the worries overhanging them whilst the Brexit situation is unclear. So we see a few companies coming around and talking to us about trading that kind of business out of Asia, which if they're new to Asia is exciting for us because there's every chance they may trade one of our exchanges in Asia.
Thank you. And Chris Edmonds?
To get a little bit more specific, I do see the opportunity where a number of what I'll call traditional European clearing members have had to retreat a little bit out of some of their global footprints, and it's created opportunities for non-bank FCMs like Phillip Capital to become part of that ecosystem in a larger way. But there are some issues if you have trading portfolios that span both sides, and you need to have capital efficiency between that. And certainly the EU's perspective under MiFID around how many levels or how many chained entities that you can have, and the limitation of 4, I think in the general sense, well, if you go exchange to clearing member to an introducing broker, and then introducing broker to an end user, you can't go further than that. So it calls into question some of the carry broker relationships that have historically been the basis of a lot of the growth within the Asian region, that make it difficult to flow transactions back into Europe or to hedge that risk on a different venue within the same clearing member. I still think that is a struggle that we as an industry have to get right and have to face. And to Chris's point, we don't yet know what Brexit is. It doesn't necessarily, depending on what hour. I mean, we've been here for a couple of hours. Maybe it's changed since we got in here. But yesterday I heard we had a deal, then I heard we didn't have a deal, and so I'm not going to handicap if we have a deal on that or not. But we are potentially a victim of whatever deal is cut or isn't cut through that opportunity that will have an impact on the customer base that's serviced by all of us and through the likes of Phillip Capital.
Thanks. And finally, Rama, how's it impacting you?
Yeah, I think Chris put it quite nicely. I mean, it's true. Brexit in itself is still yet to play out, right? We still need to see what the full ramifications of what eventually is closed upon to see the impact it'll have. But there are definitely elements that we kind of anticipate, and as exchange operators, as regulators ourselves, we will have to work with the corresponding parties to ensure that we can facilitate flow. Thus far, I would say the only impact Brexit is having is really us facilitating or figuring out how to facilitate access to clients, as some of our clients actually setting up in locations outside of London, outside of the UK, and to the extent that we need to support them, we're figuring that out. It's still very early days though. MiFID, on the other hand, has had a bit more clearly impact in the system. We run the cash equity markets for Singapore as well as the futures markets. We have seen a drop-off to some extent in the availability of research on corporates and companies that can be made available to institutional investors and other investor types groups. So we've had to step in where we can with our own brand of research of sorts that we can take to market, and working with partners to see how we can make available research that can help investors make more informed decisions, because otherwise they're going to be operating in a bit of a vacuum. Aside from that, I talked about it earlier, we're seeing flow of OTC business onto exchange platforms. Just in the last 9 months, we have seen a pickup of about $20 billion worth of margins in terms of open interest positions that has come onto the exchange platform, purely on the back of trying to deal with the uncertainty of what they have to do in terms of reporting requirements for MiFID. Another opportunity we have seen actually at the exchanges, we have seen the need to actually get involved in the index space. We have built up a small business, but nicely picking up in interest, where we can be the calculating agent as a neutral party for institutional investors who want to put out index products or wealth management products for their investor base. And because of the MiFID requirements to have neutrality, we play that role and we can operate in that space. So that's a new opportunity that we have seen that we've tried to capitalize on. That's the SGX experience.
Thank you. We're going to get to the topic that's on everyone's mind. Why didn't the Cubs make the playoffs? No, seriously.
Don't come to me for that one.
Seriously. In the past year, the U.S. government has decided to implement a trade war with China and, to a lesser extent, other countries in Asia. How is this affecting your markets, and how can traders capitalize that? Chris Lee, I'll let you take this one to start.
Well, it's obviously added volatility to the markets, and traders love a bit of volatility. I think long term, obviously, nobody really knows how long that will last, and a downturn is often followed by a very flat period. So I guess, although it was quiet times, middle of the year was busy times, beginning of the year the volatility has increased, so the markets have been busier. I think though the trade wars, it's clear nobody's probably going to ever win a trade war, but I think the one thing that's happened in our region is it's probably accelerated the China dream of that. They've got a dream called Made in China 2025, where no technology is imported into China, and they make their own technology, design their own technology, and build their own technology to become self-sufficient. And I would imagine in Xi Jinping's words that's probably going to accelerate that passion to do that, which probably is not good for either side of the world when it comes together. And there's no holds barred that the Chinese are quite keen by 2050 to be a world-dominating power. So I'd imagine the trade wars don't really help anything to sort of slow that down. That in itself, I think, over the next few years, if the trade wars don't stop, will play into those markets, and volatility will continue, and markets will enjoy volatile times, but where it ends, I don't know.
James, how is it impacting you?
Thanks. Yeah, I mean, the Chinese trade war hasn't affected the market where we are at this moment. I mean, more pertinent to us would be on the same kind of page would be the Iranian oil sanctions, which have really affected the region and the exchange in general, in particular rather. Taking that amount of barrels off of a daily export from Iran and asking the rest of the Middle East to try and fill that gap has meant we're going to see some very volatile trading on our exchange and all the other exchanges as well from the region. It's very, very difficult to know how that will play out. What we are seeing is some big movements in crude at the moment, and that does directly affect our trading base. What we're always concerned with at the exchange are price movements that are too volatile and then sort of scare off customers. That's something that I'm always aware of. So we're entering a very interesting stage for pricing oil out of the Middle East. There is talk of $100 a barrel again, and no one seems to know if that's going to come off or not. But the general feeling is that it's highly possible.
Thank you. Rama, how's it affecting you in your markets?
How is it affecting me? Okay. Well, long and short, as colleagues have said, trade wars are not necessarily things that people like to see or be involved in, right? Creates uncertainty, brings in uncertainty, and has definitely impacts across the board in the long run. It's still early days, it's still not really hit. Nothing has really had any huge impact. Having said that, at the end of the day, China would slow down is not necessarily good for anyone. But if the market needs to participate and trade in and about China, opportunities will exist on different exchanges. So Singapore Exchange is the only marketplace out there that does list product across the board, whether it's currency, equities, commodities, covering China and Japan and the rest of Asia. So as a marketplace, we like volatility. Too much of anything is bad, agreed, but we like volatility, and all this volatility will bring opportunities for participants to get involved in and trade. So we will see more flows, more trades. Now, what I'm going to say next, I'm not 100% sure if it's because of the trade wars or not, but we're starting to see a lot of Chinese in Singapore, a lot of Chinese firms in Singapore, which hitherto hasn't been the case. There are more brokers in China who are applying for licenses with our regulators in Singapore and applying to the Singapore Exchange to be full clearing members of the exchange. 6 months ago, I think 6 months ago, a Chinese exchange has set up shop in Singapore. And there's talk about another one also going to do so. Is all that not because of the trade war, but is all that diversification that China is putting in place, or participants in China putting in place, which allows them to also participate through a Southeast Asian vehicle or marketplace to deal with their risks potentially, yeah. But what it does mean in the short run, what we're seeing is, yeah, there's more flows, more capital coming into Singapore, more capital that's being available to participate in the marketplace. So I'm not seeing the negative impacts of it, but in the long run, yeah, none of us like a trade war. It's not going to be good.
Finally, Chris Edmonds.
I'm just trying to figure out who you spoke to get the ability to say it was a trade war. I mean, did the administration give you clearance on whether you could do that, or are we in a safe city here and that's okay?
It's a trade conflict.
Trade conflict.
Trade conflict.
Got it. So, from our markets, I would say that the biggest impact is likely on our softs complex. And as Lynette proved earlier today through her box exercise, there are a number of us that are addicted to coffee, and where that is. And so as I see coffee, sugar, and cocoa on a global basis, while the price activity has been and the average daily volume have been great, the actual delivered supply is at all-time lows, and something almost in a decade in some of these products that we see. So there's the volatility that my colleagues on the panel have made reference to, but the underlying economic value of the physical commodity at the end of the day is kind of where it is based on fundamentals. So it's not really reacting at this moment in time. You know, whether that changes over the long haul, I think the biggest thing that I focus on is you know, you might argue that some involved in the debate are playing for a 4 to 8 year window, or maybe I should say 4 to 6 year window, and others are playing versus a 200-year window. And at some point in times, you know, it may feel like you're winning, and other points in time, depending on your vision of the future, you're not on the right side of that transaction. All of that uncertainty, while we say we don't want it, that is what employs most of us in this room and a part of this conference that will take place here today and the rest of the week is we all have a different opinion, and we're able to put risk capital to work against that regardless of how it works out at the end of the day. So to me, I think it's about what your time horizon is, and you're going to make your bets along that way.
Just changing it up a little bit, Rama brought up a really good point with his MiFID II discussion regarding research. Are you as a group, other exchanges, are you looking into offering research more directly to clients in addition to what you have? Are you going to try and generate any revenue from it, or is there any kind of change in course there strategically, or are you just going to continue to offer it as a value add to the clients? What's kind of the thought process there? Chris, you can go.
Which one?
The research question. Yeah. Are you gonna?
No.
Oh,
Chris.
Oh.
Well, I can answer it, and then it's easy.
Sorry, you were looking at me.
My answer is no. So it's over to you.
Well, Well, certainly most of the activity we have in the region, as far as growth and number of human capital in the region, is based on this. I mean, obviously our acquisition of Interactive Data Corporation, they have that. We see a tremendous engagement from clients in the region who want index-based services, whether that's calculation agent or specific indices developed for their own personal business at the end of the day. So it is a very active conversation with us, and that spans the full gamut. It's from pricing analytic data, it's from reference data, it's from the index itself. The entire life cycle of that is a very active business for us in the region. So it'll be one more thing I get to compete with Rama on as he continues to build out his offering there. But I may be slightly ahead of him on this one at this point, as I'm the little brother on the exchanges when it comes to the island of Singapore.
Chris Lee, what's your thought on the research?
I don't think we've got any intention today at this point. We'd be looking more into data products, but not necessarily research products from our side of things.
And James, anything from you?
No, not for us. Dave.
Interesting. Okay. All right, and then one other piece that Chris brought up was the fragmentation. One of the things I took away from this panel last year was when Rama's colleague was up here. He mentioned, all the opportunities for arbitrage that there are in Asia. Do you guys think, and you can please jump in wherever, do you think that with the increase in fragmentation and volatility that's going on with everything, that the arbitrage opportunities are going to kind of make themselves more known to U.S. markets or to U.S. participants, or is it something that's going to continue to be kind of an Asian-only trade, I guess is my question.
I can say that. I guess from our perspective, a lot would depend on how China develops and opens itself up, whether if it opens some of its contracts up, its derivative contracts up, to outside investors to freely trade in and out, then you've got a wealth of obviously contracts out in Europe and the US and in Asia that would equally act as great arbitrage and probably bring liquidity to all of those. If that method is very closed and very difficult to do, then those opportunities within and in China, out China, become obviously a lot harder. That said, in the region, there's different arbitrage opportunities for sure, and I think we at the exchange try and build an ecosystem. Rama tried to claim that that's the only place you can do all this stuff, but we build an ecosystem with ETFs, futures, options, indexes, stock options. China connects with stocks, Shanghai, Shenzhen. So the arbitrage opportunities in that little ecosystem alone is absolutely enormous, which is why we attract the sort of businesses we do, the size of volumes we do, and the ultimate market cap on the exchange. So I think the opportunities are big. And I think 24-hour trading or 40 or 17, 18-hour trading now makes this thing also much more exciting. Technology's moved forward. We're seeing traders sitting in New York, Chicago, trading our after-hours futures markets, our after-hours option markets, and it's now a real prospect to actually sell that thing to them. So they're not necessarily trading those outright. There's an arbitrage going on between certain things. So I think it's an arbitrage globally, really.
Great, thank you. James, how would you answer that question?
Well, traditionally, from the oil market, there's been a number of arbitrage that have been available to all the traders. The trouble with traditional arbitrage opportunities that have worked, they work until they don't work. And what we've found with extra volatile crude prices in the last couple of months is that the old arbitrages are not working, and that's a concern for us because they're the kind of trades that our customers rely on, low risk. Will that some become big risk, and certain arbitrage opportunities, they're even more riskier than taking an outright position on a crude contract. So, that's what concerns us at the DME more than anything at the moment. We do like a settled oil price, and these markets, although they are volatile and some traders will benefit from that, generally speaking, we're happier in volumes and liquidity with stable arbitrage, which we're not quite getting at the moment.
Thank you. Chris Edmonds?
Yeah, I believe there's an opportunity for different parts of the market to carve out their own niche, and they will have different experiences along the way depending on where, either on the curve or within a vertical set of products that they choose to operate. If I think about the crude space, we have seen, a constant, mostly from the commercial players, constant requests for development of very specific product constructs that work within the region, so they know they're hedging that risk out specifically, that then you're going to back into the other speculative part of the marketplace who want to take that and facilitate the arbitrage that Chris was referencing. So I think there's more of that product development that's going to come forth. I think that product development will lead to increased opportunities for all market participants to take advantage of. However, those don't happen overnight. So while it works for a given counterparty in the space, and they may have a lion's share of the commercial activity or physical production activity, and they need that doesn't always translate into a product that the masses wish to trade and invest in. However, we all know from a market construct perspective, we need that rubber meets the road customer as part of the basis, as much as we need every other participant there. Otherwise, it becomes a bit of a self-fulfilling prophecy that we don't like the outcome, because when the light switch turns off, so does the liquidity that comes with it.
Thank you. And finally, Rama, what's your...
Thanks. Yeah. My perspective on the matter would be, first of all, good thing we didn't focus only on China, because China takes a long time to open up. And we actually looked at Asia as a whole, as a marketplace, to ensure that we can provide various products, which essentially now lead to a huge amount of arbitrage opportunities which exist right now. There's a lot of intra-Asia trade that takes place. There's also a good amount of business and arbitrage trading that takes place from American-based institutions and participants who have actually made their way to Singapore, to Asia, to Hong Kong as well, and they trade from there. But there's a huge opportunity still for participants out here to get involved in the arbitrage trade across all the asset classes. And I think it's incumbent upon us as exchanges from Asia, incumbent upon the brokers like Phillip's Capital, who are powerhouse in that part of the world, to actually make sure that we take the message out to the participants in this room and to other and beyond here, to identify the opportunities that exist and how they can provide access. We can provide access to our marketplaces. From Singapore Exchange's perspective, we see the opportunity so important for us that last year, October, when I was here in Chicago, we opened our first office, sales office in Chicago, and we started off with one person on the ground. Today, 1 year later, in fact, a few weeks ago, we've now expanded into two other cities. We've got an office now besides Chicago in New York and in San Francisco, and we have got now 5 people in the U.S. 1 to 5 is a big number. It's still small overall, and we're looking to put more people on the ground out here as well. And that's really on the back of trying to work with the institution and the trading community here to get more involved in the opportunity space back in Asia, predominantly in Singapore. But frankly, anyone who trades into Asia and into Singapore can't be just trading into Singapore alone. There's some very good opportunities across the various exchanges on the previous panel and this panel. So there's a huge opportunity for you all to get involved in the markets in Asia. And you're missing a trade, you're missing an opportunity if you all don't make it out there. The sooner you all do, the better for you all and for us.
Thanks, Ram. Thank you. And then finally, my last question for the group before we open it up for questions. This is something near and dear to, I know, Chris Lee's heart. Broadly speaking, people have been referring to the 21st century as the Asian century. Do you think this constitutes a last mover advantage, and how do you capitalize on that? Chris Lee, do you want to lead us off here?
You sound like I'm a guru on this subject. Well, I think there's a last mover advantage that's being played at the moment. And to be honest, when I went to HKX and started dealing with China more, I didn't even realise there was such a thing called last mover advantage. And that's in technology, that's probably regulatory, that's probably in market structure from an exchange perspective. And if you look at the way the Chinese are expanding and growing, and now their economy is growing, and only 30% of their country are sort of middle class. The last move advantage there is things like payment systems, technology. They're are becoming self-sufficient, and all the incumbent technology, they've jumped the PC generation and moved to mobile. You go to China now and you hardly can pay by cash. It's all online payments. The government actually issued a statement the other day saying that stores had to take cash because tourists can't get the online payment systems that the local Chinese can get. So it's leaps and bounds ahead of where we probably in the Western world would think technology is. But I also think last mover advantage probably has a cycle, because eventually somebody else is going to have that last mover advantage and grow. The fact is that China's obviously a 1.5 billion person population, so it's slightly different from most other kind of countries. So yeah, I don't know whether, I'm not saying anyone's going to win out of that, but there's definitely a last mover advantage being played.
Interesting, thank you. Rama, what's your thoughts there?
I'm not too sure how to answer the question. I mean, frankly, last move advantage. I mean, there's a lot of opportunity out there, right? You talk about technology, as Chris points out. Yeah, the way things work in Asia are quite different from the way things work out this part of the world, right? Where there's payment systems, the use of technology. I mean, you look at online shopping. Southeast Asian, the amount of time that people spend on online shopping and transactions of products on the internet is about 2-3 times more than what you find out in the West. And the use of technology in terms of last mover advantage out there is potentially, yes, paramount. It's interesting. But at the end of the day, is this the last opportunity for Asia? I think there's so many different dimensions to look at it. From our perspective, it's good to be in that part of the world, a lot of opportunities, and we will just keep thriving to deliver products and services that meet the needs.
James, what's your thoughts?
Yeah, I mean, I think Chris answered the question as I would have myself, but in terms of the exchange, DME, I mean, we are tied to China. I mean, 80 to 90% of our crude ends up in China. The interesting thing about where we are, I think we were more of an Eastern Asian exchange 5 or 6 years ago than we are now, and this proves the cycle. Of all our customers, our biggest customers this year have tended to be from west of Suez, which is interesting for us. And we've got much more customers, so we've become a much more global exchange in the last few years, even though our oil ends up in China. The amount of time it goes through the chain, the amount of people interested in trading and not taking delivery has grown. So we see ourselves, yes, it is the Asian century, but for us, it's looking like a global century for the exchange itself, and that's important for us.
And finally, Chris Edmonds.
Yeah, so your question assumes that all the lessons learned through the history of financial times are only the best practices are implemented at the time of stress. I think the history of financial times says that's not always the case, even though we know the right answer. Sometimes, whether it be regulatory or human elements, and get involved in a time of stress, and there's an outcome that wasn't planned, and that's the next new thing. So I struggle with saying that it's a complete advantage. While certainly there's more data available, there are more experiences, life experiences, market experiences that can be modeled, studied, and learned from. At the time where that black swan event faces the industry, we all have to make a decision. And I'm not exactly certain that just because Asia is the last bastion of hope for us to go through and monetize, that says we're all going to make the right decision at the right time. I hope that we do. I'm not trying to paint a pessimistic picture, but it would be the first time in history that all of those lessons learned were implemented exactly the right way at the right time in a moment of stress. And that seems to be a poor bet on a historical basis.
Thank you. I'm going to take a moment now and open up the room to questions. If there's any questions, please raise your hand. Okay, I got one. So what contract and exchange, in your experience, has the most traded stock index future and the most traded currency future? Rama, I think it's...
Sorry, what's the question again?
What's the most, I guess you guys can duke it out. The most traded stock index future and the most traded currency index or currency future.
So if you flick back to my slide, It's up there.
Yeah, but after I finish talking.
It's up there.
Yeah, okay.
We don't need Rama to answer this question. That's the most traded index future in the after hours, of our after hours, which is relevant to Chicago, right? It's in Chicago daytime. That's the one in red that's up there that says it trades 3-point-something billion. I think SGX is up there. Yeah, I can see SGX.
Thanks, Chris.
FXI. Thanks, Lynette. That's a brilliant question.
Yeah.
We know who bought dinner last night.
Like,
And
there's no need for Rama to talk.
Well, the currency future.
Currency
Rupee,
future.
I don't think you guys trade a rupee.
I'll carry on the currency future talk. Okay, so
CNH.
Rama has a bigger currency future in terms of liquidity, but he doesn't have any options on its currency future.
That's true. By the way, anyone who wants to help us develop the options market, just look for me later on.
Rama, shush. And to be fair, Rama and I put our arms around each other because we'd probably both have a smaller currency future if neither of us existed.
That's true. That's true. Yeah, at the end of the day, it's not. I think Bill spoke too early. Bill heard it when he said that in the previous panel nobody talked about volumes. I'm sure he'll be, kicking himself now for having said that. We're all talking about volumes now. But again, it's not the biggest always wins, as we all know sometimes.
It was earlier.
But we all respectively bring different things to the table, and so our offerings will serve the needs of the market as much as the other person's.
It's much more interesting when it's free flow, isn't it?
Well, I was going to say, from an arbitrage opportunity, CNH, I think you guys both trade a CNH contract. There's a perfect arbitrage opportunity there.
They're both different. Ours is physically delivered, and Rama's is cash settled. So it suits some and it doesn't suit others, depending on where you want to trade.
Yeah. Are there any other questions?
Come on, let's carry on the fight between me and Rama.
Well, I'd like to thank you guys. Is there one?
There's somebody in the back.
My question is for Christopher Lee from the China Exchange. You mentioned about the in and out. I was on the trading floor at the Merck for over 25 years. We're looking for guys like me. How do you see their entry coming in the future? Is it something that's really far off? I mean, you would never get someone like me to trade a market that I can't sell.
I don't think I actually totally got the question.
So how would you open? How would you sell your market to a floor broker or floor trader in the U.S. where there's barriers to entry that they might not understand?
So in the derivative space or the cash equity space?
In the derivative space.
In the derivative space, I'd sell you the after-hours trading so that you can sit here during the day. I said to you, we've extended it out. I'd sell you the HSI future, which trades now, as I said, till midday Chicago time. We'll trade out till 2 p.m. Chicago time by the middle of next year. It's got options on it, so Chicago being a big home of index options, you can market make it freely, you can prop trade it freely, you can algorithmically host servers on our colo freely, and then if you wanted to, you could then join the daytime session. Our after-hours futures is trading about 20. Yesterday it traded 25% of its daytime volume in the after-hours, so it's significant. That's what I'd sell you, and I think there's probably people in the room that's heard that pitch about 3 times this week. Does that answer the question?
Sure.
Are there any other questions?
That was James' question.
Well, I'd like to thank our panelists. Thank you very much, gentlemen. It's always a pleasure.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.